Hey, welcome back, everybody. So I've been circling around some numbers for a while in the economic space, and trying to analyze them and put them in a way that makes sense so that people can understand it in more than the 10-second snippet that the news gives you. But here we go. So what I've been looking at is what in the economy is real and what is fake. So I've been digging into inflation numbers. I've been digging into housing numbers. I'm digging into housing costs relative to income, what's the average cost of a car versus the average income, all kinds of videos all over the channel. You can check them out. But this one I wanted to kind of say, look, are we actually on the edge of a full-blown crisis? Or are we just picking winners and losers? And is the winner going to be the family or corporations? How's it going to work? And it's some really interesting stuff, depending on how you look at it. Right now, there is a huge push for the Federal Reserve to cut interest rates. What the heck does that mean? So all of a sudden, companies are reporting their quarterly earnings, and things aren't going so well. So the stock market, certain key indicators, certain key stocks in the market are coming down. Intel being one of them most recently, and that's causing the down numbers to decrease. And of course, nobody likes it when the down numbers decrease, and that all makes the news. One of the ways you can prop that up is by the Federal Reserve cutting the prime lending rate. Well, what does that mean? Well, let's go figure it out. And what does that do elsewhere? So if you cut the Federal Reserve rate, does it just impact the market or does it impact other stuff too? It actually impacts all kinds of things. So one of the things that matters here is the average earnings, right? So that becomes part of this conversation. It has to be part of it because inflation becomes part of it in a minute. Now, over the past 12 months, average hourly earnings rose by 3.6% or $1.23 an hour. Sounds pretty good, right? Maybe. But if you look at that 3.6%, we're still recovering from years where rents were increasing by 8 and 12%. Cost of housing was increasing by, 20, 30% if you're going to go buy a new house. Interest rates on a mortgage went up. Interest rates on car payments went up. All that stuff increased. And I did a video digging into the how inflation is calculated. It was pretty interesting stuff too. They included some weird things in that calculation, but this is very real, right? So people's salaries went up by 3.6%. That's not a bad number. That's actually pretty good when conditions are normal. So our condition is normal. Well, the consumer price index, what is that inflation rate? Well, the CPI is this market basket of goods that includes everything from shelter, motor vehicle insurance, household furnishings, operations of your home, electricity, stuff like that, hopefully, medical care, personal care. It includes airfare, used cars, trucks. It also includes some less discussed things. It actually includes and it gives weightings to each one of these things. It includes things like the cost of a private plane, because why wouldn't you include that in that calculation? And I've got a video where I actually go through their database and call a few things out. One of the things it includes is a weighting criteria. And I found it interesting that the weighting criteria for going to a museum was given more weight than somebody going to a movie. Now, I don't know about anybody else, but I actually go to museums, but not many people do, at least not at the same rate we used to. And I would probably think more people are going to movies, or at least partaking in that form of entertainment, than are going to museums on a regular basis. So I don't know why they chose to give museums a higher percentage than they gave movies, but there was some really questionable practices in that calculation. And the other thing you see is the CPI number, this consumer price index number, which is essentially inflation, always comes out in two versions, right? So it comes out in this all items or all items less food and energy. Why would you take food and energy out of that calculation? It doesn't make any sense to me. But this is still sitting somewhere between 3 and 3.4%, which is not good if your hourly earnings only went up by 3.6. So you maybe did a little bit better than inflation, but maybe not, especially given the last 2 years where wages have not kept pace with inflation by any means. So, that's good news and bad news kind of wrapped into one. Now those two numbers are just about tied, which is okay, but we'd really like to see, numbers go up faster, the salaries go up faster, or at least, slightly better than the 0.2, and in very little, at least, recover from the last couple of years. Uh, so that means inflation is still really a problem, right? It's still out there. It still exists. And I just did back to school shopping with my kids today, and it's a very real thing. Inflation is not zero. It's still hidden. Now, one of the other things that's coming up that's popping around in news right now is housing prices. Well, the housing prices over the last couple of years, and again, I did a video on this, have gone up so far, so fast that everybody goes, "Hey, it can never come down. This is beautiful, right? Just buy 3 houses and you'll be fine." Well, the trouble is they got so high so fast that a lot of people who don't already own them can't afford them. So those people have to rent. Well, now rents are going up by 6, 8, 10, 12%. So how do you save money for a down payment? That becomes a problem. Also, with the high rates for mortgages right now, remember for years they were like 2.9, 3%. Now they're up at 6 and 7%. That's, a lot harder to buy that same home. So let's say you're buying a $200,000 home at 3% versus a $200,000 home at 6%. That monthly payment is considerably different because that interest rate's a lot higher. Now, the median price for a household in the United States is starting to come down. So in Q4 of 2022, it was $442,600. Q2 2024, it's 412,000. So it's come down considerably. That's causing panic. What's happening is now all of a sudden everybody wants that prime lending rate to come down, that Federal Reserve rate, because what that'll do is it'll lower mortgage rates, and I'll explain why in a minute. But if you lower those mortgage rates, more people can afford more expensive homes. So a couple of things can happen when you lower that prime lending rate. It can make the housing market stronger. It can make those prices go back up. It can bring more people back into that market, hopefully. And it could prop up the stock market. Well, why? What the heck does that Federal Reserve rate mean? Now, if you also look at the housing market collapsing demand, and I messed up that chart, but we're going to go back to it. If you look at the collapsing demand inside the housing market, you can see it in a couple of different ways. And the interesting bit about that is that yes, the demand is going down because of the interest rates, but how do you tell it's going down? Well, the mortgage applications are decreasing. They're at their lowest rate since 1995. Why does that matter? Well, 70% of the people buying a house don't do it with cash. They do it with a mortgage, right? So is this a bomb waiting to go off? Is this the big problem? Because look, since 2020, man, it's just dropping like a rock, which means the demand in the housing market is gone. So from 2008, when we had the housing crisis, we were kind of going up. We had more people applying for mortgages. We had people paying cash. We had companies investing. Now all of a sudden it's coming down. It's coming down hard on the number of mortgage applications. And I actually talked to a couple of realtors who have seen mortgages on substantially larger homes than they used to, which means people have kind of run out of their cash. Now, here's another problem. Unemployment rate is on the upswing. It's still sitting somewhere around a 4% number, give or take. Somewhere between 3 and 4%, and that's a little higher than we would. If you're without a job, I know it's a little higher than you'd like to see it. And look, it's a number that's on the rise. Big tech companies are laying people off. Other companies are laying people off. They're just doing away with positions because of automation and AI, and that's happening at a faster and faster rate. And it's mid-level management positions that are largely being affected, at least the ones I've seen recently. Now, again, if you lower that prime lending rate, companies might hire some people back, but is that good for the overall economy? Well, let's look at this. So the federal funds effective rate kind of came down in 2019, 2020 to basically zero. It was 0.08%. Well, what the heck does that rate mean? That means if I'm a bank or I'm a big company or I'm a hedge fund or mutual fund, I can go off and borrow money at prime plus some very small number. So if I'm a bank, I can borrow it there. If I'm a bank or a big company, I can borrow it at something really close to that. It's not expensive at all. And 0.08, think about this for a minute. If you're a hedge fund and you're borrowing money, let's call it at 1%, and you can go put it in the stock market and get a 3% return, you borrow as much money as you can, and the stock market goes up even higher and your rate gets better. If you're borrowing money at 2 and 3% to buy homes, you buy as many as you can buy, because hopefully that appreciation rate will be better than the interest rate you pay on the mortgage. You're basically gambling with other people's money. But the problem with that is that injects more money into the economy, that money multiplier effect, and it can cause inflation. Well, to pull the money back out of the to keep a healthy economy, this is what the prime lending rate's been over time, is it's been somewhere between sort of a 0.5% and as high as 18 in the 80s at one point. But we tend to keep it, the Fed has always said they kind of like it around 5. That means everything's kind of healthy and working right. But since sort of that 2008 crisis, where the mortgage companies just about melted the economy, it's been pretty low until sort of 2016, 2017, and then it started to go back up because the economy was doing well, and we started pulling out that excess cash out of the economy that was out there, just sort of sort of free to everybody. And also we had a little bit of inflation occur. But then COVID hit and we dropped it to basically zero. And even throughout that, right after that 2008 crisis, it was never down to 0.08. 0.08 is basically free, right? Just go borrow as much as you can. Well, so they raised it to 0.2, and now it's back up in the sort of 5.3 range, which is what it takes to really pull money out. Well, that's a big problem. If all that money is sitting out in the economy and it's changing hands fast, things can go really crazy on inflation, which we've seen with home prices. We saw with grocery prices for a while. We've certainly seen with cars. I've got a whole video on that. The average car in the United States, average new car in the United States, is now almost $48,000. Um, and if you look at the average income at 60,000, that's a big number compared to the average income. Now, so the challenges we face right now, if you look at all the videos I've done on these topics, we still have excess money out in the money supply, lots of it, because it's been floating around the stock market. It's been put into speculators, into houses, and those house prices have gone up and up and up and up, and you see no chance of coming back down anytime soon, at least until maybe soon. Might happen. It seems to be happening. I think it's going to become pretty bad. We have resistant unemployment. We have persistent inflation that doesn't seem to go away. We have lots of investors that are propped up. Their net worth is based on the housing market. No one who's not in the housing market seems to be able to afford one right now because those prices have gone so fast, so far, so fast. The stock market is starting to crack. So if you lower rates, a couple of things could happen. You prop up the housing market, you prop up the stock market probably. That doesn't help people who aren't already in those markets get into them, because remember, we got sort of 50-60% of the United States living paycheck to paycheck. And if you live paycheck to paycheck, you're not going to run out and buy a house because you don't have the down payment, right? You barely affording your rent at this point. But again, if you lower those rates, inflation could be back off to the races, right? So the Federal Reserve has this real problem, and policymakers in DC have this real problem. How do you stick the landing? Since COVID, we have printed money like there is no tomorrow. Google it yourself. Look at how much the money supply has increased since COVID. And it has gone pretty crazy. The Federal Reserve has those numbers if you want to go look at them. It's the St. Louis Fred database. I don't know why they call it Fred. But if you go off and look at that, all that excess money could lead to excess inflation. Excess inflation, when your wages aren't keeping up, could decimate certain families. So we're basically at a point where we kind of have to make a choice. How does the economy continue to function? Are we going to just kind of say, okay, well, let's prop up the stock market and home and people who own real estate? Or do we say, hey, look, families really need help too? And how do you balance that? And who's the right person to make that call? The Federal Reserve, because they're under pressure from Wall Street and banks and mortgage lenders to go off and fix it, bring that rate back down so that, hey, we can keep enjoying this rising in our investment dollars. Whereas families are going, please don't beat us up with inflation anymore, right? So, do you pick winners or losers, or do you try to find a happy middle ground? I don't know which way that's going to go. I do know that the pressure to lower those rates is certainly out there. Whether or not that's going to succeed, I don't know. Whether or not they're going to come down, I don't know. I know there's a lot of people saying, oh, it's going to come down, it's going to come down, it's going to come down. Please lower it today, lower it today. Well, the Fed Bank is not meeting again until September, so it's at least not coming down until then. And if it does come down then, does that really impact anything for a while? Well, it really doesn't, because once they lower rates, it does take a while for that to trickle into the economy. So are things going to improve? I don't know. Are they going to get harder? I don't know. But I can tell you that mortgage rates and auto rates, which are a lot higher than they used to be, are not coming down anytime soon. So right now, to buy some of those larger ticket items, it's taking a larger amount of cash than it ever has before. And the number I saw when I looked it up is sort of 50-60% of the United States is living paycheck to paycheck and has less than $5,000 in savings. And you're not buying a house with $5,000 down, right? Unless you use a VA loan. or some other 100% financing, which has got us in that, which is what got us in that 2008 crisis in the first place. So we're in a really precarious position economically, and I don't know how you fix it. I do know that historically, at least in the last 20 or 30 years, we've had a tendency to pick winners and losers. So the big question is, who do we pick? Who's going to get picked by policymakers in DC? That's what I think is going to happen. They're going to pick their favorite. They're going to go that direction, and I think somebody's going to wind up paying paying the price. Big question is who. So let's stay tuned and see what happens. Everybody have a great day.